Do you like selling covered calls, or do you want to know more about selling covered calls? Specifically, do you want to know how to sell covered calls on Apple in a bear market, right? Great stock, bear market. Can you do it? Should you do it? We'll talk about that in this video. Hey, welcome back, everybody. It's Mark Yegge. I'm a wealth architect. I help 5 and 6 and 7 and 8 figure investors play offense and defense with their portfolios. And we do it by creating safe, reliable return in a program we call the cash flow machine. One of the things we do in the cash flow machine is we show people how to buy and invest in covered calls, right? But it's not just basically covered calls. It's covered calls with a strategy. So today we're going to do covered calls on Apple in a bear market. Right now we're in the middle of a bear market, and you're going to see it. As soon as I put this Apple chart up, you're going to be like, ow, I think you're going to be like that. Okay, so here's the Apple chart, and you can see that it's coming into a pretty rough bearish position. Like we've got what, 4, 5, 6, 7, 8, 9 out of 10 weeks that have been down. That's a pretty rough streak to be sitting through. So all things being equal, you'd rather be buying Apple maybe right now than sitting through all that. That being said, I'm not sure it's the right time to buy Apple. Like, we have 4 cornerstones that we talk about. We want to talk about the right stock in the right market at the right spot on the chart. And then what we do is we squeeze the juice, or we collect the rent from the stock. But you've got to start with the right stock. Now, most people think Apple is a great stock, and there's a difference between the stock and the company. So the stock right now isn't a great stock. Nonetheless, if you're a value investor, and we're generally not, we like breakouts, but right now there aren't a lot of breakouts to be found. So now we're looking for a little bit of value, and we're looking at Apple, and it's showing us, wow, 8 out of 9 or 9 out of 10 weeks, it's gone down from a peak. And, at some point, somebody's going to step in and start buying it because it's on sale, right? I don't like that term, but there's been a lot of selling, and margin calls and hedge fund liquidations and pension fund liquidations have driven the market down to pretty good valuation. So the risk is now asymmetric to the upside. You get lower risk, hanging to the downside, but you might have a nice bounce that gives you some good risk. So if you like Apple, and that's the part of this that, we're not going to talk about, Apple's followed all the fundamental criteria that we like. If you like the stock, now let's talk about doing the options on it. So if you want to do the options on it, you take a look at the options, right? So I brought up an option chain. The stock right now, 142.38. And here is the option change. I just froze it in time because I don't want to have it flipping around on us. But, Apple is at 142.38. So it's over the 142 strike price. Now, in a bear market, in a market where I think there might be a couple of more corrections coming, there might be some sell-offs coming, I don't know, I'm not going to get greedy. I'd rather just make a little bit of money and move along to fight the next week and have a little bit of cushion. So instead of selling the 142s here, what I'm going to do is I'm going to sell the 140s. Okay. Now let's take a look at those 140s. When you sell something, you get the bid price. So you're going to buy the stock at 142.38, and you're going to sell these 140s at 525. You see that there? So 525 is the bid. $2.83 of that is what's called time premium. And time premium always works for you when you're the seller, works against you when you're the buyer. So you get $2.83 in time premium. And by the time this thing expires in 11 days, a week from Friday, basically, you're going to get $2.83 just for the time premium. That's what we're after in our program called the cash flow machine. We don't care if it's up or down or what. We're after the 283. And it's really hard for most people to get their brain around that. But once you start getting your brain around, that's what you start to key around. So let me show you how the math works. Hey, it's Mark Yegge here to tell you about our cash flow machine trading program that's designed to teach you how to make safe, reliable income. Now, we shoot for 2 to 4% a month of income and growth in your portfolio. And we have courses to teach you how to do this yourself or inside a mastermind community. And the best part of that is it only takes about 20 minutes a week to implement. Now, while 2 to 4% a month doesn't sound like much, I show you exactly how we took my IRA from $111,000 to over $500,000 in just 19 months without huge risk. I'm not telling you this to brag, just to show you that you can do this too. So to learn more about this program, go to cashflowmachine.io. That's cashflowmachine.io. mathworks.io, and you can learn more. Math works like this. You buy the stock at 142.38, and then you sell the 140 strike calls. Now they're in the money by $2.38. It's the 140 strike calls, right? So now it's a higher opportunity or probability that it's going to get taken away from you. Well, that's part of it. If you want to let it get taken away from you, that's fine. You can also roll it. But we're going to sell the 140s at 525. So we pick up 525. That's a net to us. So that's why it's in red. We're selling it. So we get it. And then basically what happens is we've got a net basis now of 137.55. We brought our price down, or our cost down, or our basis down from 142.38 less the 525 to 137.55. So now it's already caught. We're already in Apple for 137.55 when it's trading at 142.38. We're already in it at a bargain, if you want to look at it like that, by 5 points. All right, here's what could happen. A lot can happen. It could close at 180. It could close at 100. But let's be realistic, and we have to assume that within 11 days, stocks go up, stocks go down. We have to make an assumption that the stock is going to close above 140. Heck, it's $2.38 above 140 today, right? So if you can get it to close at 140, here's what you end up making. You end up making a $2.45 profit. It's the 137.55 as your basis minus your 140. You make 245. 245 divided by that net basis gives you 1.8% for 11 days. Now, CDs don't even pay 1.8% for a year. Here we are getting 1.8% in 11 days. Bonds don't pay 4% in a year. We're getting half of that in 11 days. Yes, there's risk. Tesla can go down. Apple can go down. Apple can go up. It can do all kinds of things. But chances are it's probably going to stay the same or above 140. And, the higher that you are above the strike price, the higher the probability the stock is in the money at expiration. Now, you get all that $2 and whatever I said it was in time premium, but you also get that cushion if it goes down. If you think Apple is a value and you think it might bounce from here, and you want to collect a little income and do it a little bit conservatively in case it goes down, give yourself a cushion. You look at the 140s that go out 11 days and you end up making 1.8%. That's how you make money on covered calls in Apple in a bear market. I think that should help you. And if you would, like and subscribe, all that stuff, maybe hit the notification bell. We'll let you know as soon as another one of these comes out. We do these in our cash flow machine program all the time. It's not just covered calls. It's a system, an ecosystem around covered calls. We have a mastermind group that keeps you accountable and is a supportive community. It's a lot of fun. But anyway, if you want to find out more about it, I'll probably leave a link at the bottom. Maybe I'll even throw a commercial in here somewhere. But that's what we do. Pick up 1.8% in 11 days after the market's gone down like relentlessly. Maybe this is a good opportunity for a value bounce. So hope that helps. See you next time.